Well, thanks for joining everybody. Thanks for joining us, everybody. I can't even talk today on Friday, Mike.
I'll take it over if need be.
It's been one of those weeks. I'm just like running around like crazy, trying to get ready for this new baby to get here, and my mind is not fully here. So if I say anything stupid, one, it's pretty common. I do it quite often, but please forgive me.
I'm just gonna assume you got started on the margaritas early on Cinco de Mayo.
Yeah, well, speaking of Cinco de Mayo, so our planning topic, we'll talk about kind of 5 things to know in the spirit of Cinco de Mayo. I had a pretty big May the 4th be with you yesterday, though. I mean, I got some Lego Star Wars built, pretty, pretty serious Lego Star Wars model creation over there. Had a great time doing that. You do anything? You're not a big Star Wars guy.
The Force may have been with you, but it was the Fed.
I don't know. The Force may have been, but was the Fed? That's a fantastic question, Mike. And so just a quick reminder, nothing we talk about here is specific advice for you. You should know that, but they make us say it anyway. So just if you have any questions, we're always happy to talk to you. But Mike, what in the world's going on out there? If you're a regional bank, you're going to have a bad time. I learned that this week, depending on what regional bank you are. Some excitement with the regionals, big Fed meeting. You've got some notes from that as well. What's going on? Where are we going? What's happening? Bring us.
Yeah, those are the main highlights, and we also had the jobs report, but I'll kind of go in the order you just touched on. Regional banks, we saw First Republic. We talked about a little last week how they had big selling pressure in their stock. Well, they did go under. JP Morgan ended up buying them out, got a pretty good deal on that. So surprisingly, markets were pretty calm Monday, and then they digested that information. Then Tuesday, they decided, well, let's freak out again on the regional banks. So you saw huge sell-offs from a couple notable ones, including PacWest and Western Alliance. They're down big, and then continued on Thursday after the Fed meeting. So I think both of those are down about 70% from where they were a week ago. And that's even more so where they were before this whole banking thing started on the second week of March.
Yeah.
So we'll have to see what happens with that. They are getting nice bounces today. I think both of them are up like 40, 50%, but still decisively off their lows. So I'm sure we'll be hearing more about them in the next week or two. So we'll see how that goes. When it comes to the Fed, they raised rates by 25 basis points. That was widely expected. So they're now in the range of 5 to 5.25%. Now, their language changed a little bit. Before, their messaging was, we anticipate further tightening may be warranted, to they will determine whether further tightening is warranted. So they did put the pause on the table. I was kind of in the camp that they would probably pause, but we did get a hot jobs number today. Came in well above expectations. I think it was 253,000 jobs added. They did revise lower the previous 2 months, so that's interesting. But looking at the 3-month average versus last 3-month average, that is continuing to decelerate. What's a little more worrisome for the Fed is the wage growth is pretty strong. It increased 0.5% on the month and sits at, I believe, 4.2% on an annualized basis. They really need that number to get closer to like the low threes to be consistent with their longer term inflation goals. Mm-hmm. So today, market's getting a nice bid. We're at the highs of the day right now. It is a down week overall. I think part of the upswing today is Apple had a pretty good earnings report yesterday. So as you know, that's a big weight in all the major indices.
Yeah. Mike, that kind of brings up an interesting point. I don't mean to derail you here, but something we talk about internally a lot that I don't think a lot of people think about. Because we say the market, when we say the market, we're generally referring to the S&P 500, and all the talking heads on TV always refer to the market. But I don't think many people realize just how concentrated returns have been this year specifically. But I think that's been a trend over, all the whole time you've been managing, is that there's some years where there's only a very few small amount of companies that are actually making headway to keep things afloat or doing well. And I think that's something, maybe if you just want to touch on that and explain what
Yeah, so
happened.
I think like the top like 6 or 7 stocks have made up 70% of the return on the S&P market cap weighted index this year, the one that
Mhm.
everyone looks at. Now, if you compare that, for example, to the equal weight S&P 500 actually dipped negative yesterday, and I think that the Dow Jones was in that same territory. So there's a big divergence in the market. You
Yeah.
have a few sectors doing very, very well, and that's pretty much the largest stocks in those sectors doing well, and the rest of them maybe not so much. And then you have the more cyclical and even defensives are kind of lagging this year. So it's definitely an interesting market. Looking at the S&P 500 market cap weighted index, we did dip below that uptrend line from the October lows. Now, we are touching up to that today, so we'll have to see if we break back above that or not, or whether that the downtrend continues that we saw earlier in the week. But the good news is there's plenty of support underneath. We have all the major moving averages, the 50, 100, and 200 day within 3% below. So there's plenty of places that the market could bounce. But I've been in the camp that I think we're gonna have some sort of correction, and that kind of aligns with my views that we are in an economic slowdown, and there is a high probability of a recession either late this year or early next year.
I think we're all in the same boat. A lot of those conversations we've been having have been similar to that. I think the recession feel is very real. And I think, anytime recession comes in, it's a big, scary, dirty word. And like people want to press the brakes, hit the panic buttons. Can you talk us through what a historical recession looks like, Mike, and what that actually means from
Yeah. So an average, I mean, there's plenty of ways people try to define it. Two consecutive quarters of GDP, which we did have last year. That's not really the true definition of a recession, the true classification. There's also earnings recession, which it looks like will be in our second quarter of consecutive declines this quarter. So technically an earnings recession, but it really measures a broad economic decline in the economy, ranging from labor, which has been very strong, to overall economic activity. Now, labor is typically the last leg to fall. So even though the jobs market's been strong, that kind of flips pretty quick toward the end of a cycle. The unemployment rate usually troughs before the recession starts. So we are seeing that. We just hit 3.4% on the unemployment rate, down from 3.5% last month. Now, from a market perspective, certain things will hold up better. Defensives tend to do better. And if we do end up getting rate cuts, higher valuations, like more stable companies like tech companies should do well with those rate cuts. But overall, on a broad indice level, the average drawdown is about 30%. So not too far from what we saw in October. And I'd be comfortable in a buyer if we got back down to those levels. I think hitting those in October before the recession actually started isn't something that typically plays out.
Mike, that makes perfect sense. So I think that's an awesome recap of where we are, what we're looking at kind of going forward here. And then, speaking of decreasing interest rates, that brings another, we'll do a Peter Griffin, that what really grinds my gears session here this Friday. So when we think about lower interest rates, a lot of people have bought houses recently, and they're really thinking about, hey, I hope interest rates go down so I can refinance. And everybody got a nasty surprise, and something I think maybe one of the stupidest things I've ever seen, in that if you have good credit and you make financially responsible decisions, you're going to get charged more money to have a mortgage now. Obviously, it's a revenue grab by Fannie Mae and Freddie Mac to try to fill their pockets and build that up. But I've always believed that if you empower people to make their own personal financial decisions and good financial decisions, we're going to be much better off as a country than if you tell people, you know what, you're doing a little too well. Let's spread the wealth around. Historically, that hasn't worked, and that's certainly my opinion. But just something that I saw, and just don't understand what policymakers are doing when they put stuff like this into play. I'm going to avoid getting all real political, but about lost my mind when I started reading that. So the good news is like how it logistically works. It's only applies to new or refinance loans backed by Fannie Mae or Freddie Mac. So realistically, it's not going to have an impact on anybody who already has a mortgage. You're not going to pay any extra fees there. But just one of those things you just scratch your head and think, sure, there's a reason for it somewhere, but why would we punish people who are making good financial choices and being good stewards of their money? It's something that I just can't get behind.
Yeah, especially right now, if you look at like the average home price of like 400,000, where interest rates are currently at, they're paying already another $700 a month than they would have 2 years ago.
Mm-hmm. Absolutely. So I don't know. I still think when we get into that, and when we wind up in that recession, whatever it happens to be, I'm sure we'll go through more than one in our lifetime. So whenever that recession happens to get here.
While we're on the topic of bad government decisions, we also have the debt ceiling coming up. Nice. Janet Yellen said that we could default as early as June 1st. So that's going to be in the headlines in the next couple of weeks. So
well, that's always exciting. It's one of
now historically the U.S. has never defaulted. They've come close in like 2011. They came real close, and Moody's actually downgraded the U.S. debt. So even getting down to the wire could cause a lot of disruptions in the financial market. Mm-hmm. But historically, they ultimately either suspend it or raise the debt limit. So it's something to be on your radar, but historically, it's always worked out.
Yeah, I'm not too concerned at it. We always just raise the debt ceiling up. What's another couple billion?
I did buy a little exposure to a gold miners ETF this week. So that's a little hedge. I think there's some components that could work to its benefit besides the debt ceiling coming down on the wire. Like I think our central bank is probably further along in their tightening cycle than international, and so I think that should continue to put some pressure on the dollar, which typically is a good environment for gold-related assets. Yeah, I'm not telling anyone to go out and buy gold, but that's just kind of what we're doing in our portfolios.
Yeah, that makes a lot of sense. So I'll kind of segue off my what grinds my gears, Peter Griffin Friday, and go into kind of 5 things to think about in the theme of Cinco de Mayo. One, most importantly, Mike, what's your favorite margarita flavor and style over there?
Regular?
You're standard.
I'm a pretty traditional guy. And I like both the crushed ice and then the just cubes. So either way there.
You like frozen and on the rocks. Is it salt, no salt, sugar?
I'll do salt occasionally.
You're a pretty salty guy, so I figured.
How about you? I take it you have a little more flavor in your margaritas.
Well, so when I don't partake anymore, but when I used to partake, there was a restaurant here that had a mango flavored margarita, and that was always my go-to. It was always the mango flavored one. I like the little.
Were you getting the big fishbowl ones?
Big fishbowl mango margaritas, nothing better. Oh, so now that we've got the important stuff out of the way, we'll give you kind of 5 tips to leave here with from the planning side of things. And one is have a goal. Write it down and review it often. I think that's one of the most important things about goals is actually going and writing them down because they're really just thoughts and wishes until they get written down. And here's a good way to think about goals. We can use the acronym SMART. Specific, measurable, achievable, realistic, and timely are what we want to do when we're kind of setting goals. We talk about some other tips for investing. Give yourself as much time as possible. Einstein said the greatest force on earth is compound interest. And he was right, in my opinion. He's a much smarter guy than I am. So if you give yourself as much time as possible, the likelihood of you reaching your goals are as good as they're going to be. So next one is save as much as you can. So find some discretionary money in your budget, save until it hurts, and then adjust downward as necessary. So that's one. People rarely adjust upward. So starting at a level of uncomfort and then adjusting down if needed can really help you squeeze out some more annual savings than maybe you would have otherwise. And then save as often as you can, daily, weekly, monthly. We got little kids at home. I'm probably going to have a swear jar soon and start putting like dollar bills in there to make sure the kids don't pick up any good habit or bad habits. And then pick an appropriate place for, higher yield or growth. So if your time frame's longer, right, like 7+ years where you think you're not going to need access to those funds, that lets you maybe invest in something a bit more aggressively than something you may need in 0 to 3 years or 3 to 7 years. So utilize different buckets for different goals as well. That's kind of the fifth piece of advice I have. That's it. Everybody have an awesome, safe, happy, healthy Cinco de Mayo. It's one of my favorite holidays. I'm going to go find some delicious Mexican food and celebrate somewhere today for sure. I think tacos are in my future. Definitely.
I'm going to have some Chipotle for lunch.
Well, I
can say that's true, authentic Mexican, but
yes,
still tasty.
I'll give you like half a point there. You get half for celebrating the holiday. A huge thank you for everybody who came to our community shred event here in our Bridgeville in our Pittsburgh office here. Had a great time. I think we had about 60 or 70 people show up, almost filled up the whole shred truck. So it was great seeing everybody come out. Thank you. We're gonna be doing that annually. So it's just a way to say thanks, help people get rid of some unwanted documents. On a side note, have some very exciting announcements coming soon as far as just some stuff that's been in the works here behind the scenes. Nothing to announce quite yet, but keep tuned. We've got some exciting things on the horizon that we're very much looking forward to sharing with everybody. In the meantime, we'll chat with you next week. Hope you guys have a fantastic weekend. For all you husbands out there, it's not this weekend, but next weekend's Mother's Day. So make sure you do what I'm going to do and wait till probably Saturday, not this week, but next week before you do anything about it. So have a fantastic weekend, everybody. Mike, take care over there.
All right, you too.
We will chat with you next week, man. Take care.